Hey friends, it's Iggy from the Investing Iguana. Today, let's walk through the daily SGX market digest together, almost line by line, so you get the same clarity as the Substack version, just more fun and conversational. If you're new here, I've spent years breaking down Singapore markets so you don't have to stress over jargon or headlines. Ready? Grab a copy and let's dive in. So, the big hook today, Singapore opened firm even as global noise stayed loud. Why? Because MAS kept policy steady and Q3 GDP surprised on the upside at 2.9% year-on-year. That set the tone. The STI ticked higher in the morning, Yangzijiang shipbuilding popped about 2%, and breadth looked healthy at the open. Now you might be thinking, does a small STI rise even matter? It's less about the number and more about the signal. Investors are still willing to take risk here when the local macro picture holds up. Let's set the stage with the market summary. The Straits Times Index edged up at the open, helped by the MAS decision to keep its exchange rate policy unchanged. At the same time, Singapore's economy printed a stronger than expected 2.9% growth for Q3. Construction and services did the heavy lifting, while manufacturing was flatter. Think of it like a three-legged stool. If one leg wobbles, the other two can still keep you steady. For us as investors, a resilient domestic backdrop supports banks, developers, and service-linked counters. The key question is, does this help dividends and earnings hold up into year-end? Short answer, yes, selectively. All right, first headline, MapleTree Logistics Trust wraps up an Australian exit. They completed the divestment of a Victoria logistics property for a $60 million, about $50.4 million. After this sale, MLT still has a hefty 174 properties and roughly $13 billion in assets under management. Units closed flat at $1.26 before the announcement, which tells you the market wasn't shocked. This was consistent with their playbook. Iggy's take. Here's how I look at it. MLT's been pruning single-tenant exposure and recycling capital into higher quality, better yielding assets. It's like upgrading your rental portfolio from one big tenant to a mix of dependable tenants across prime locations. What should we watch next? Two things. Where the proceeds get redeployed and any distribution per unit friction in the interim. The base is still strong at $13 billion AUM. If you hold MLT for income, keep an eye on the next results for DPU cadence and occupancy trends. The strategy is sound. Execution timing is the variable. Now let's head to Keppel REIT's big move. Their first pure retail play in Australia. A private placement of $113 million, 115 million new units at Stirral 983s paves the way for a 75% stake in Top Ryde City Shopping Centre, a substantial Sydney suburban mall. Units are slated to begin trading on the new issuance Friday. What's notable here isn't just the price tag, it's the pivot. Keppel REIT has been known for offices. Now they're stepping into suburban retail. Why does that matter? Iggy's take. This is a diversification call. Suburban necessity-focused retail tends to behave differently from CBD offices, often more defensive, anchored by grocers and services. Management says the deal is accretive, which income investors like to hear. The placement pricing below the last close is standard. It helps get the raise done. The next checkpoint is integration and how the retail exposure balances the Singapore office core. If Australian household demand holds up, this could smooth the REIT's risk profile. If I had to sum it up, same Keppel discipline, new growth lane. Let's zoom back to the macro for a minute. Singapore's GDP beat at 2.9% year-on-year with 1.3% quarter-on-quarter seasonally adjusted growth. MAS staying steady makes sense. No need to tweak the slope, width, or center of the policy band when growth is resilient and inflation is manageable. Here's the practical bit. Steady policy reduces uncertainty for corporates and lenders. That supports earnings visibility for the banks, while construction and services strength filters through to developers, transportation, and consumption-linked names. Is manufacturing flat a worry? Sure, but think of it as the economy shifting weight to the legs that are stronger right now. Iggy's take. Honestly, this is one of those prints where the headline and the policy call line up with what retail portfolios need. Stability. If you've been waiting on the sidelines for a panic dip, you might not get it in the near term unless external shocks flare up again. The way I'm approaching this is to lean into domestic earnings resilience while keeping powder dry for export-sensitive names if manufacturing reaccelerates later. Now, a regional twist that still matters to SG investors. Genting Malaysia's move to privatize Genting Malaysia with a R6.7 billion offer at RN2.35 per share, about a 10% premium to the last traded price before suspension. If successful, Genting Malaysia delists from Bursa Malaysia. Why should Singapore investors care? Capital flows and valuation markers don't stop at borders, and gaming assets are a bellwether for consumer risk appetite in the region. Iggy's take. Here's my honest take. This is about control and long-term execution without quarterly noise. Resorts World Genting remains a unique asset in Malaysia. By taking it private, Genting Malaysia can sequence capex and expansion on its terms, including international projects, without public markets second-guessing every milestone. For minority holders, the premium is respectable, even if some hope for more. For us in Singapore, the signal is that corporate actions are alive and well in ASEAN, and comparable asset pricing can ripple into how the market thinks about leisure and tourism plays closer to home. So, what does the day feel like in one breath? Cautious optimism. The STI's morning rise isn't a moonshot, but the breadth and macro context show a market that wants to climb a wall of worry. For strategy, two threads stand out. First, REITs are not asleep. MLT is tidying its portfolio while Keppel REIT is actively diversifying. That's management doing the heavy lifting for risk-adjusted returns. Second, the GDP beat with steady policy underpins domestic plays. Banks for loan growth and credit quality, developers for construction tailwinds, and services for steady demand. By the way, if you want the written breakdown and the clean structure to revisit later, the full post is on Substack. The link is just below. You'll find the same flow we're following here so you can jump to any section you care about most. All right, bringing it home with Iggy's personal take. If there's one thing to remember today, it's this. Don't let a quiet green day trick you into complacency, but also don't talk yourself out of a solid setup. MAS steady plus GDP resilience equals a supportive base case. On REITs, pick management teams with clear capital recycling roadmaps. MLT and Keppel REIT are showing their hand. On equities, keep a Singapore core for stability and add selective cyclicals tactically rather than all at once. And keep an eye on manufacturing and external demand. If that turns, it could be your cue to rotate into more export-sensitive counters. Here's how I'm framing portfolio moves in plain English. Maintain core holdings that benefit from a steady domestic economy. Use REITs with disciplined capital management for income, and reserve some cash for opportunities if external data wobbles markets. If I could give you one rule of thumb, own what your sleep can handle. If the headline risk keeps you awake, you've sized it too big. So if you're planning your next move, keep the backdrop simple. Supportive local macro, active REIT managers, and ongoing corporate actions in the region. What are you looking at this month? Banks, defensives, or a few tactical cyclical names? Tell me in the comments. It helps shape what we dig into next. Quick note, if you want early access to deep dives and community discussions where we workshop portfolio ideas for Singapore investors, consider the premium membership. It's a small step that gives you first look at research notes and strategy sessions, and it helps keep this channel going. If you found this useful, the next video to watch is my breakdown of Singapore REIT cash flows and interest rate sensitivity. Perfect companion to today's MLT and Keppel REIT moves. I'll see you there.